All right, don't look now, but Apple's hot again. I mean, Apple, and not because of AI, right? I mean, the iPhone 17 selling briskly in the United States and China. Apparently, customers are also raving about the latest iPad. Loop Capital, some others, just in the last 24 hours, all looking at it going higher. They're talking about this new adoption cycle. But I got to tell you, my next guest, he's recommended that stock on this show 3 times this year. So let's bring in Albion Financial Group, their Chief Investment Officer, Jason Ware. Jason, congratulations, my man. So everyone's giddy over the iPhone. I'm like 17 versions of this thing. It was plotting for a while, just plodding along. Now revenues are expected to go higher. Is this what you were anticipating?
Hi, Charles. Good to be with you, and thank you for the hat tip. And look, the short answer is yes. I don't know why anyone is surprised that Apple is back in the good graces of the market. I mean, let's be honest here. Apple is essentially the U.S. Treasury bond equivalent in the equity market. This is a company with an incredible balance sheet, the best balance sheet in the world, has incredible free cash flow as well, and a sticky installed base of iPhones that, quite frankly, 300 to 400 million of them are older than 4 years old and need to be upgraded. So here comes the iPhone 17 riding to the rescue with a little bit of a fresh design, probably the biggest design upgrade in the last few years. We might have a foldable coming next year. So there's, I think, more excitement in the revenue growth for iPhone going forward. And oh, by the way, they have a pretty strong business in services and apps as well.
And I guess, too, Jason, this also gives them the luxury to be late, so to speak, right? I mean, they're not always first when something new, hot, and exciting like AI comes around. And sometimes the stock takes a hit for that, but to your point, it always recovers.
Yeah, that's right. And again, I mean, I think there's a floor to Apple's valuation, and that floor is higher than your average stock in the S&P 500 because of the aforementioned quality fundamentals. It should have a premium. It's trading right now at around 35 times trailing, 31 to 32 times forward earnings. And in our view, there's just no reason it should go much below that, just given the stability and optionality, given this huge cash flow profile.
All right, so in baseball, Ted Williams was known as the splendid splinter, and you've got the splendid 6, okay? So Apple's one of them, yeah. Microsoft, NVIDIA, Google, Amazon, Meta. I mean, for the most part, you just don't sell those names, right? You hold on to them.
Yeah, I mean, like there's staples in the portfolio. We used to call them and still sometimes refer to them as tech generals. Our Splendid 6 is essentially the Mag 7 minus Tesla. Tesla has a valuation that's too expensive for us, 150 times earnings. We just can't quite get there on the valuation. But these other stocks, whether you go across Amazon and Apple and Google and Meta and NVIDIA, they're trading anywhere between 22 times forward earnings and 30 times forward earnings. Right. Very reasonable for the growth profiles. That growth is still somewhere between 15 and 20% over the next 12 months.
I saw a name on your note that you're looking at. I think either you're buying it, you bought it, Salesforce. Salesforce has been getting hammered pretty good, but this is a pretty good spike right now, lifting off the 200-day. Obviously, a lot of room to the upside, but the question is, again, getting back to AI, will they survive the threat of AI?
Yeah, it is the key question, and it's the reason that enterprise software stocks this year have underperformed, and Salesforce has certainly been part of that. It's this idea that, are we going to have the moats of these enterprise software companies shrink because of AI? And I think, broadly speaking, that is true. Software companies don't have as wide and defensible moats as they did 2, 3, 5 years ago. But I think there are some quality names within that complex, like Salesforce, that again have a really strong installed base that's going to be hard to upend and replicate. And meanwhile, they are certainly doing their part in moving towards AI. You'll hear Benioff talking about the agentic enterprise a lot. Right. We think that's the future over the next 3, 5 years, and they're leading the way.
And Benioff, let's face it, when they get it right, he gets the benefit of the doubt, and that stock does come back every single time. Hey, before I let you go, 30 seconds. The growth industrials, for many months, I think maybe for the first 5 months, industrials had a huge lead. They've kind of, slowed up here a little bit, but you like these growth names in industrials, Amphenol, Quanta, and Republic Services. I just got to ask about Republic Services, because that's like the old Sesame Street, not because I have on a big bird suit, but because it just doesn't seem like it fits with the others.
Yeah, no, I hear you. It's a very boring company, so it doesn't feel like it should fit within the growth basket. But this is a company that operates in essentially a three-horse race with a couple of other large players, including Waste Management. And there's a huge M&A roll-up opportunity for Republic Services. Meanwhile, and here's the kicker, they have a renewables business in natural gas that is really growing quite quickly, and they are the leader in that space. So it has a stable business. There's a bull market in garbage, believe it or not, and they have the couple growth kickers as well over the next 5 years.
Yeah, and that nat gas story, I think it's undertold with respect to data centers and all the electricity demand. Jason, good stuff. Congratulations
100%.
again. Thank you.